So the Bank of Canada just paused their interest rates. Are you ready for what comes next? Navigating the financial world right now is as difficult as it's been at any point in time that we've seen before. Very often stocks and bonds and even the central banks aren't really acting in the way they have historically. The Bank of Canada has declared a war on inflation, vowing to bring down inflation rate to their target of 2%. And over the past several months, we've seen that inflation heading back towards this magical number. Each time there were indicators that there might be a pause in interest rate hikes, but the Bank of Canada just kept raising interest rates. In July, we saw an increase in inflation rates for the first time in several months, increasing from 2.8% to 3.3%. And many experts expect another interest rate hike when the Bank of Canada met again earlier this week. That was not the case, as the central bank decided to hit a pause button, keeping interest rates steady at 5%. The bank left the door open for future hikes, but many experts are expecting the rates to hold steady until sometime mid-2024. All right, so what does this mean? First of all, there can finally be some reprieve for homeowners who have seen mortgage rates skyrocket for the past 18 months, but we're not really going to start seeing that pullback until we start seeing that inflation stabilize around that 2%. The ability to pivot and adapt will continue to be a major factor in maximizing your investment returns over the next several months and possibly even the next several years. But if you ever thought about owning a GIC, this might actually be the time to lock in. And this definitely goes in stark contrast to being agile, but with such a low risk investment, seeing yields around that 5% rate, this might be an opportunity to lock in that fixed income position for you. There are also tax consequences and risks involved in that, and liquidity risks when owning GICs. So just definitely make sure you speak to a professional about your own unique circumstances. Being close to or at the peak of these interest rate rises, this could be a time to consider looking at your bond portfolio. If rates fall, we can see those bond rates start to increase, especially over the short term. There are also high interest savings accounts that are packaged like mutual funds or ETFs, and they track the Bank of Canada's overnight rate. If rates stay steady, these can provide some good yields with more liquidity than the GICs. However, once those rates begin to drop, so will the yields. So this might be the perfect time to convert some of your retirement savings into an annuity. This will add some guaranteed money for life for you. The payouts on an annuity are tied to interest rates, so this might be one of the smartest times to make this change that we're going to see in a while, either looking back or possibly looking forward. Finally, with so much uncertainty on the fixed income side, it's not really a bad idea to take a look at what the super wealthy are doing with their fixed income. According to Bloomberg, Blackstone's private credit fund for the rich has seen a 30% increase in Q3, rising to about $2.4 billion of invested assets. Overall, they reported $71.2 billion into 34 new private credit funds, and institutional investors are continuing to add more and more capital into this private credit asset class. There are many reasons for this, including the uncertainty that we're seeing with central banks, buybacks now being funded largely by private credit, and the lending restrictions on major banks, especially in the US.